Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Alcana, along with Brianna Valesky, and we have Frank Holmes on the line. He's CEO and Chief Investment Officer of U.S. Global Futures. Also, he has launched the global ETF. U.S. Global has launched the ETF Jets for the airlines, and what a great day to have you on, Frank. Let's talk about the Jets ETF as well as some of the good earnings coming out of the airlines.
Well, there's no doubt it's a huge sea change, a record in not only in the U.S. but globally. But in particular, when we look at America, it's up fivefold. Every quarter for the next 3 quarters, we've already had the first quarter, free cash flow went from $700 million to $3.5 billion. And we're going to continue to see that throughout this year.
Okay, all right. Then we had some good earnings here coming out of Southwest Airlines and UAL, just coming off the lows of the move here. You expect it to continue? Or you think if investors can get a little bit of a pullback here, getting a little cheaper prices?
I think what's important for listeners is Barron's did a beautiful story 2 weeks ago, and the article was the front page of their publication and basically they highlighted. The article points out lower fuel costs, higher fees and fares, and cost cutting as tailwinds to the industry. Despite low valuations, they have the lowest valuations. So there's nothing but upside. The average S&P stock increased its dividends this year 15%. The airlines 100%. Delta was announced buying back billions of dollars worth of stock. So it's a very different industry.
Yeah, and no, I did see that Barron's article. Did take note of it. Didn't spring into action. I mean, the big sell-off, and I can't think of the conference, but I know that the CEO of Southwest Airlines, started to talk about capacity on airplanes, and then also you had the Justice Department potentially investigating price fixing. Is that is those things kind of behind us now?
I think the price fixing, talking to analysts and doing analysts who've done detailed work, that's not going to fly. But I think the real complaint is the airlines not posting all their prices for all their flights on Travelocities of the world or on the internet. So there's competitive disclosure and transparency in pricing. I think that's the biggest issue. But I don't think there's been collusion according to data mining. But what's important for and Jets as an ETF is that you get the basket of them, so you don't have to worry about one problem at an airlines. You get the basket, and 80% are U.S. companies and 20% are foreign.
Okay, let's talk about it. Why did you decide to create this ETF, and how did you go about it?
Well, first of all, I fly twice a week, 100 times a year. I fly all over the world, and I was getting frustrated and annoyed, so I did some analysis, and I bought Alaska Air, and it doubled. I mean, I just couldn't believe their cash flow returns on capital. And I said, is there an ETF for the space? Because we must create an ETF, because mutual funds are being Uberized, as a metaphor, by ETFs. And so with that, we sat down and started doing work on it. There was no other product out there. And we did what's called smart beta. We used a bunch of value screens to sift and sort and looked at time series. That is, did these factors work for 1 year, 2 years, 3 years, each year on their own? And then how did it collectively add up for the past 15 years? And we came up with this smart beta. It's so inexpensive. I love the structure of the ETF for investors, and allows them to participate in the companies which have the strongest growth in revenue and earnings, highest returns in capital, and big liquidity.
All right, can you just go over give us some of the top components in the Jets ETF?
Well, American Airlines, Delta, United, and Southwest dominate. They're about 48% of the portfolio, and it gets rebalanced every quarter. And then we go and we take a look at some of the other holdings, and they're going to be the fastest growing, like JetBlue, Alaska Airlines, Hawaiian, and then some of these companies get tapped out each quarter. They're not competitive. So we have about a number, I think, is push of 15% a quarter of rotation of names.
Okay. All right. Moving on. Another sector that you follow here, and you actually wrote a book about it, the Goldwatcher, Demystifying Gold Investing. When did you write that book, and why don't you give us your current thoughts on the gold market?
Sure. I wrote the book before gold went to $1,000, and basically, in my research and looking at gold as an asset class and having gold funds, I discovered that there are basically two key factors that drove the price of gold. One is the fear factor, which is because gold is priced in dollars, is predominantly negative interest rates. And whenever we have negative real interest rates, that is, what will the government pay you for a 5-year or 10-year government bond? Take away the CPI number. So are you a net positive, or are you losing money on buying those government bonds? Well, whenever they're negative, gold rises in that country's currency, and it's just the same as in the U.S. And up to 2011, we had record negative interest rates. So gold kept rising higher and higher to the peak of $1,900 when a government bond, a 10-year government bond, was minus 3% if you bought one. Today, it's plus 2%. So that swing from a negative to a positive rate of return on government bonds means the dollar gets stronger, gold goes down. So the very strong relationship to dollar is inversely related to gold. The other component that's so key for investors is called the love trade. And the love trade is basically the growth of Chindia. China and India, affectionately known as Chindia, which is 40% of the world's population. And they give gold for everything, for all forms of gifts, for graduation, for weddings, for anniversaries, etc. And as their GDP per capita has been rising, their consumption of gold measured in grams has also been rising.
Okay, let's get into going back to the gold market here. I mean, we're at 1,100 here. Do you see it? Do you see us going into triple digits before we get back to the $1,200 level?
You know, it could if they raise interest rates and the dollar gets much stronger, then gold could go under $1,000. But what's really important for your listeners, I've always advocated that they have a 5% in bullion coins or estate gold jewelry, and another 5% in quality gold stocks. And in particular, the royalty companies that pay out to have high returns on capital, like Royal Gold or Franklin, Nevada, listed on the New York Stock Exchange. And so that's what I've tried to always say, have that max is 10%, but rebalance each year, because there are years when gold's been up 110%, our gold stock. So it's important to take profits to buy the market then.
Do you think that, now you're getting down to these levels, you think you're going to see any kind of consolidation, amongst the gold miners?
I think there's no doubt about it. We're seeing costs being slashed everywhere. The only companies that are really competitive are the ones that have assets outside of America. So if you're a producer in Australia, well, the currency's fallen 30%. So you've had a cushion on your expense line item. In fact, the profit margin is rising. The same thing in talking to people in Canada. Some of the copper gold mines said they're making more now than they did when gold was 1,900. So I think it's because their cost structure dropped.
Okay, you see any potential candidates if we do go into some kind of consolidation phase?
I think there's got to be some rationalization between Barrick and Newmont. I think they're in the same state. Nevada is where the dominant production comes from, and it's been declining in the U.S. So I think some type of a reorg there would be a good thing for the industry. I think you're going to see some of the mid-caps get bought. Because there's a huge cutback in exploration development. So you're going to see the supply of gold coming from mines dropping. On a positive note, you're seeing central banks around the world increasing for the past 6 years their gold purchasing.
Okay. All right. Well, we touched on the gold sector and the airline sector. Do you have expertise in any other areas?
Well, resources in particular is another reason why we looked at the airline industry. And the big swing there is oil prices falling. Okay. So oil prices falling just means they're going to make more money. And most of the airlines are actually locking in their hedge books. They were hedged from last year, and they're basically rebalancing their book each month. They hedge out 12 months. So they're locking in great prices for their cost structure. And I think what's really important for listeners is that American Airlines does not hedge. It's one of the few airlines that does not hedge. And their CEO announced last month that he wanted all of his comp in stock, not cash. So that's a very positive note for the industry, that the largest airlines CEO is so confident not only in his company but in the industry that he says, give me all stock.
Okay. Also going into ETF investing here, some people, you do get the diversification. Could you just go over some of the other pros and cons of ETF investing?
Well, I think one of the important parts is the cost structure. When you look at what has amazed me is that you can do hedging, you can do so many factors what's called front end load, the rules based positioning, that the cost for managing running an ETF is that the legal overall cost structure has been rising for mutual funds dramatically in the past 10 years. In fact, I say it's up 30% in the past 5 years. Not so for ETFs. So you can pass that on to the investor. And that's what's important, and they can get diversification. It rebalances every quarter, so they don't have to worry about that they sell this and buy this when they're on their summer holidays. It's done systematically, and it's been back tested vigorously. So for investors is a wonderful way to participate in the market, and I see nothing but growing that you can trade these ETFs.
Okay. How about thoughts on just like the broad market here? We had, the threats of the Greek exit, a lot of volatility in the market, kind of went down below like the end of the trading range, but, came right back up, made it all-time high. We double-ticked there at 21.26 and a quarter. Do you see, the trading range continuing here? You see a driver out there to take us to blast off the new all-time highs?
I don't think there's any blast off. I think that the strong dollar is hurting a lot of the exports, especially high-end products. On the other hand, the lower oil prices is helping the cost structure for many companies. So that's why one is taken away, one is given. I think that companies will continue to watch their cost structure. They can increase their dividends. There's a real thought process within corporate America that if you want to have shareholders, loyal shareholders, then they're looking for the discipline of increasing your dividends. And I think that's going to hold, I guess what you call the word, support for these capital markets in the U.S. Now, what's really inexpensive is Eastern Europe. Europe's taken the sentiment in Europe's improved. It's looking at what we call PMI, Purchasing Manufacturers Index. Greece has created lots of drama, which basically gives you a great opportunity to look at those capital markets. So I think that when you look that the weaker euro is only going to benefit the Polands of the world. The Czech Republic's been doing exceptionally well. So I think that the emerging Europe's as a category will benefit.
Frank, what do you think is the best focus for the average investor right now? Our show is for just everyday Joe, retail trader, and investors. So what's kind of the best direction you can point them in our current market right now?
Whatever their age is the focus on what their short-term yields are. That is, going along the yield curve, putting too much money into long-term bonds is very risky. Short-term bonds is not. I think if you're 50 years old, you should be 50% equity, 50% into shorter bonds. I think if you're 70 years old, you should be 70% shorter bonds and 30% equity. That balancing factor, and if you're 25 years old, you should be 75% in equities and 25% in short-term bonds. I think that's the most important part of that balancing factor, so that you do have cash, and markets do correct. You can always buy things on sale. Just like you like to buy clothes, you like to buy cars or furniture, the same thing should be stocks. What I see for a lot of investors is they jump in, they're fully invested at the wrong turn of the cycle.
Frank, do you follow the bond market? Can we talk about high yield bonds?
Sure, we do. We have a fund, short-term tax-free, in fact, and it's called Near Term, and so I'm very focused on that. I'm very proud of the team. We've had out of 25,000 funds, only 25 have been up for every year in a row, and this is one of those funds that 2 interest rate cycles in the past 20 years, 2 stock market corrections, and it's been able to have positive returns for 20 years in a row. So I do follow it. The longer end, I think, has lots of risks to it. I think junk bonds you're not getting paid for the risk. You can turn around, and when you do comparative analysis, it's better to be buying stocks which are growing their dividend for that risk you're taking for junk bonds. So I think that's someone where investors have to be careful.
That's a great point. And I'm sorry, can you give me the name of that ETF and the ticker so we can take a quick look at it?
Well, the JETS is the JETS is for the airlines, and NEARX, NEARX, NEAR with an X.
Okay, great. So that's why I wanted to ask, because Carl Icahn was coming out last week saying that he's foreseeing a crisis in the high yield bond market, in the junk bond market, saying with interest rates and all of these oil producers who are probably going to default on their loans, that we may see a crash in the high yield bond market. And I've been struggling to find some people who can really talk about that, so I just wanted to get your take on that statement.
Well, I think there's a lot of what he's saying is correct. I don't know what the impact's going to be actually on the ETF space, except there'll be some redemptions to that impact. But they're not leveraged. What the real risk always in that space is where someone leverages their bond portfolio 3-to-1 or 4-to-1, and that's what creates the cascading down. But in that mutual fund world, you don't get that excessive leverage. A couple of hedge funds that are out there, I'm sure they're leveraged up to their eyeballs, trying to maximize the returns, and they're the ones that'll blow up.
Hey, that's a great point. We've been on the line with Frank Holmes. He's the CEO and Chief Investment Officer of the U.S. Global Advisors. Frank, thank you so much for joining us this morning. We really appreciated you talking ETFs, equities, macro, bonds, almost everything. I mean, pretty much everything we threw at you talked a little bit about. So thanks again, Frank, and we'll have to bring you back on the show again soon.
Well, thank you. Have a wonderful summer. Happy investing.
Thank you.